All right, good morning, ladies and gentlemen. Today is January 26th, 2022, and I'm back with another edition of the Wednesday live show. And wow, what a wild sort of market we've had over the past couple of weeks. And today is Fed Day, which is the all important Fed Day because the market's sort of thrown a little tantrum ahead of the idea that the Fed's going to taper their asset purchases and start on an interest rate hiking cycle and reduce their balance sheet, right? And so the market kind of threw a little tantrum ahead of that. And today, Powell is going to have to walk a really sort of a thin line, and he's going to have to kind of reassure the market that everything's going to be real steady and normal and that type of thing, so that so that the the market doesn't fall apart. And obviously he's sort of in a tough position because with inflation at 7% on the last print, it's pretty likely to start coming down just on its own. But hey, you never know. I mean, that's the one, part of the dual mandate of the Fed is to keep prices stable prices, and 7% inflation is not good for, I think, the administration. That's the number one thing that your average American is going to is going to notice and complain about is high inflation, right? Which we've all been seeing for quite some time. So every time I go to the grocery store, it's like the price of everything's way up. So anyway, so here's a chart of the S&P going back, quite a ways, because what I wanted to show on the chart was the pandemic sell-off here, right? And kind of look at how the pandemic sell-off, in an interesting way, kind of mirrors what's transpired over the last few weeks here, right? It's kind of interesting, because pre-pandemic, the market was in like a really nice uptrend, and then that last leg, sort of from October to March, when it started falling apart. I guess that was February. Um, just a real steady sort of uptrend. But the most interesting thing to me is to notice. Let me zoom in a little bit here. Notice that first, like, sort of really steep sell-off that took it below the 200-day moving average. The blue line is the 200-day. And notice how there was kind of, really sharp sell-off right initially that happened really quick. And then, break below the 200-day. Then there was like that spike low and a pretty big snapback. Let's see, my chart lets me go back just for the fun of it. My chart lets me go back and zoom in on that area. And so, yeah, what you got, well, I mean, there was a gap down, right? But you got, looks like, for about 5-6 days of straight down selling there, right? And then that spike low, breaks below the 200-day, spike low, and then a really significant rebound, practically, practically halfway back up. Not quite, but halfway back up there. And you had a few days where everything looked fine, like it sold off, and then you got that big bounce, and then I'm sure a lot of people probably thought, hey, we're out of the woods at this point, the worst of the sell-off's over. You got that little pivot low right there, and then it didn't take long for the second shoe to drop. And anyway, from top to bottom, you're talking about 35% sell-off in the S&P in a really quick amount of time. And then, of course, the Fed saved the day back here. So anyway, you might want to look at your own charts and just kind of look at that. And the reason I say that is because at this point in time, and I mean, it's been a brutal sell-off, but at this point in time, you got kind of a little bit of a similar pattern here. The question was whether this first drop, whether like these first and this is very possible. You had like 4 or 5 days, sort of straight down here in that spike low, and then that rebound that took it about halfway back up to in there, and then the next shoe dropped, right? And so when I zoom back out on this chart and look at it, I just see some similarities. To me, the similarity is the plunge below the 200 day, and then the subsequent, recovery for about a week, and then another leg down. And so, just be interesting to see if something similar to that transpires this time around. And so the idea here is to not get too complacent. The market participants have a tendency to want to buy the dip prematurely, and then you get a little bit of a rebound and they get all bullish again and think, the worst of the sell-off's over, and then the second shoe drops. Now, of course, this was an extraordinary and what do they call it, a Six Sigma event, caused by the pandemic, obviously. But the funny thing about this, way back before the market actually dropped, I remember thinking to myself, this little dip here was all about, the COVID, or they used to call it coronavirus back then in China, right? And everybody knew it was there, and there was all kinds of craziness and stuff. And then, the market kind of sold off just a little bit and then rebounded like it wasn't going to be a big deal or a problem here. And then all of a sudden, when it came over here, that's when the market like really sold off. But the funny thing is it was kind of one of those things where everybody knew ahead of time. I mean, it wasn't that difficult to assume that it was going to end up spreading, globally at the time. And so, but it was just weird how there was sort of a delayed reaction for the market to sell off. So anyway, same sort of thing here. The Fed came out last meeting and it was all hawkish and talked about rate hikes and tapering, rate hikes, and reducing the balance sheet. Like those are the three things that they're going to try and do to control inflation. And then of course, these Fed speakers, man, they come out and there's just they say all kinds of stuff, and some of them appear to be extremely hawkish, and some of them are not. And so it's really hard to know exactly what they're going to do, but we've seen this movie before, right? Remember when Janet Yellen was Fed chair, they talked about rate hikes and they would always put them off, and any little sort of market tantrum, the running joke is that anytime the market sells off, the Fed turns dovish again, and they delay the rate hikes. This time around, I mean, the whole like QE thing is kind of ridiculous at this point. I mean, they'll come on and say that the economy's doing just fine, and the funny thing is they like to point at the unemployment, but I mean unemployment has bounced back. There's tons of jobs open, and so they've really they got a tight rope to walk. But anyway, let's look at some of the damage that's occurred in the market. I mean, it's been pretty amazing, quite honestly. Um, Whoops, what happened there? Yeah, I mean the S&P just barely even reflects some of the real damage in the market, and consequently, for a while here we haven't had a whole lot of stocks that have set up due to a combination of things. One of which is that the stocks that have kind of have sold off to set up for a swing trade, just like sold off and sold off and sold off and got obliterated. And so we're no longer in like primary uptrends, right? And so that was part of it. And then of course now we're like headed into the thick of earnings season. So we had well, I'll get to the trades in a minute, but let's just look at the speed and severity of this sell-off. I don't think anybody was expecting this. And then, of course, I'm starting to see stats like, this is the worst start to a year since 2018, or I think 2018 was pretty brutal. Or was it 2016? I think it might have been 2016. Yeah, 2018 is the opposite. It was the market ripped higher in 2018 in January, and everybody's kept saying, so goes January, so goes the year, and then it ended up being a down year. But it was 2016. The S&P to start the year fell like 11% in a straight line. So, but anyway, we did that was sort of a panic capitulation, sell off and reversal that we saw the other day, and you know, I saw some stats that said something like, being down over 2% and then closing higher has only happened twice in the history of the market, and that type of thing. So anyway, yeah, I mean, things have definitely gotten loose. And then, of course, the ranges have just gone crazy. So the 30-day ATR on the SPY is 697, which, let me just do the math here real quick. I have to break out my calculator. 697 divided by, we'll just take 442 current price is, that's 1.576, so 1.57%. So you're moving, over the last 30 days. Now, if I back that down to like a 14-day ATR, which I'm not going to do because it would even be more dramatic. So, I mean, this market is, when the market's moving up and down, 1.5%, 2% on a daily basis, there's just no telling what happens next. So, and then the craziest thing about this, or one of the crazy things about this little sell-off here was yesterday, right? Like after that dramatic intraday reversal on Monday, then yesterday there was a humongous gap down, right? I mean, they ran it down overnight, just kind of like they ran it up overnight tonight. So there's absolutely no telling. I mean, this thing could be up at 450 or it could be down at, 425 by the end of the day. And it's all going to depend on the reaction to what Powell says. So it's definitely interesting. And then, of course, there's a lot of other weird stuff going on. Well, not weird stuff, but, there's the tensions in Ukraine again, which reminds me of a lot of, I guess it was 2016. We had the same sort of thing, right? Or there was geopolitical tensions in over there in Ukraine with Russia and all that, and that happened in 2016, and this is a similar situation. And so anyway, that's kind of like a little bit of a sword of Damocles hanging over the market, right? The Olympics are coming up. I believe they start next week, and so a lot of geopolitical stuff out there. The S&P, the S&P looks one way, and then of course you have the NASDAQ, which I believe sold off even a lot more than the S&P, right? The NASDAQ, the tech stocks, a lot of the tech stocks just absolutely obliterated. And I've talked about these stats in the previous weeks, and so at the lows here on Monday, I think you had something like, like 20 something percent of the S&P stocks were over their 200-day moving average, and so it was kind of an extreme, honestly. We hit some extremes, and just looking at the chart here, you've got some symmetry along with what that looks like. Now, percentage-wise, I don't believe it was. Well, hang on. See, I can never, it's hard to remember exactly what these percentages are. Whoops, I didn't mean to do that. So, the easiest way to figure out the easiest way for me to figure out what the and this is not 100% accurate because you change it to a line chart when you're doing the performance, and so you're not actually it's not actually catching the intraday highs and lows, but there you go. And these charts leave a lot to be desired when it comes to that. So I mean, you're not catching the intraday move here, and so the only way to really get an accurate percentage, and of course, I think there's something to be said about line charts because they use closing prices, which is obviously the most important. But I think that's why they like to use them on TV too, because a line chart, you're gonna so you got like 14% sell off. But I mean, if you change it back to open, high, low, close chart, if you actually do the math, it'll be fun to do it. So I had my calculator over here anyway. So let's just see what the high to low on the NASDAQ 100 is. So let's see, the high that day was 408.19 minus the low that day was 330, 408. We'll just say 408.19 minus 334.15 divided by 408.19 is 18%. Okay, so there you go. So 18%, pretty significant, right? I mean, that's about as close to a bear market as you can get. And of course, it was short-lived. So I always like to use the intraday high to low because you get weird stuff like this, because you get these weird intraday moves. And so, I mean, the thing of it is that, to me, the NASDAQ, it hasn't even rallied back to where people were freaking out because it was tanking, right? And so this is still, kind of vulnerable looking, if you ask me. The market, when it sells off, it has a tendency to like sort of snap back because you get dip buyers and dip buyers. And I mean, for as long as I can remember, yeah, I guess since the 2009. Since 2009, everyone's been sort of trained to buy every dip. And then if the dip keeps dipping, they keep buying. And then eventually you get sort of a bounce back. So the real interesting thing is the Russell 2000, right? I mean, the Russell 2000, there's this huge support level. Well, you remember I had that box drawn on this thing. Let me see if I can find that. See what it looks like. Yeah, I remember I've had this box on here like, well, all of last year. And so look at how it broke down and literally lost lost a year's worth of gains, right? So at the lows on Monday, the Russell 2000 was sitting at a 52-week low. And so this is a kind of a nasty chart. I believe the Russell was the first, on Monday, the Russell was the first to bounce back, but then it was extremely oversold. If you look at this chart, all the other indexes, actually the NASDAQ peaked prior to the beginning of the year, but the S&P, basically hit a high right before the beginning of the year and then sold off. The Russell had that fake breakout, and so this is a pretty nasty chart. Actually, all the charts are pretty nasty, and one of the reasons is that there's just a ton of overhead resistance to chew through, and it remains to be seen how much time and how much all this can snap back at the same time. And so quite frankly, I have no idea what happens from here. To be honest with you, no idea what happens from here. Longer term though, this is a pretty ugly pattern, right? You got to be a little bit cautious. And the simple fact that the Fed is entering into a rate hiking cycle at the same time that the economy is slowing down. And so, the one thing, the Dow looks a lot more, the Dow was obviously a lot more dramatic on the sell-off, the pandemic sell-off, than it looks here. So that's kind of interesting. But hey, the Dow's had an incredible sort of snapback. And again, it's snapping. All these indexes are like snapping back into overhead resistance. And so, well, I hate when that happens. I do that all the time. Right, type in SPX because I like to look at quite frankly the SPX is the main index that I follow, obviously. So I mean, here we are. There's the 200-day moving average, right? And you get a sell-off like this, and you can't really see it on the chart. So let me pull it up. Whoops. No, I didn't mean to do that. Yeah, these charts leave a lot to be desired, but they are what they are. Anyway, look at that RSI. The RSI really got buried. Really got buried, and so it's starting to come up now. The market was extremely oversold. There's a couple things that are interesting, obviously, in hindsight, is this divergence. Like the market made a high over here and pulled back some, and then it made a new high, but the RSI, like if I drew a trend line across that, that would have been a negative divergence. But there's been plenty of other times where you got a negative divergence on the RSI, and the market kept going up. I mean, I could go back and show you several of them, but not a big deal. But anyway, the crazy thing is how oversold it got on the daily time frame. But here's something else that's really sort of interesting is, let me go back here. Just want to point this out real quick because I thought it was pretty interesting is, all right, so look at how the RSI got like super oversold, down here, right? Back in February, did the same thing. It got like super oversold, but look up here at the chart. like it got oversold on the first leg down, and then it was a big bounce, right, for a few days, for a while, worked off some of those oversold conditions, and then look at that, and then the big drop happened. And so you can't just necessarily look at the RSI and say, oh, okay, it's all, everything's cool, right? So that's kind of interesting if you compare, what happened. But what's happening now is it's hard to compare to the pandemic sell-off. The only thing worth comparing, I think, is just sort of how the chart looks, right? So, but that's kind of interesting because the RSI, it was the same sort of situation. It was extremely oversold. They bought the dip. RSI went positive, and then there was another leg down. So I guess it just depends on how things transpire from here. What Powell says. Typically when and it's been a long time since we've seen this sort of craziness here prior to the pandemic sell-off. And so that was its own sort of animal. But I remember back in, there's 2018, 2015, 2016. I remember those periods of time when we'd get this sort of price action. And generally speaking, I mean, you get a lot of sort of, you get these humongous moves in one direction in backing and filling, just like what we saw yesterday as opposed to Monday. Like I think a lot of participants maybe haven't been around that long, and so they tend to think that the worst is over when you get that first sort of spike low. But the playbook typically is a lot of up and down, sort of, filling this zone here. So it wouldn't. I mean, it's possible. We've seen enough sort of V bottoms, but like look over here, right? And like late November, early December, you had some long range bars, and look at how they sort of, day to day covered each other up, and then finally, you escape from the pattern in one direction. And so, like, these few days here, so from like Friday's high to Monday's low, there might be some more work to do in the 4,300 to 4,400 range. Just saying. And of course, it's possible that that was the capitulation, and then you get a rally back up here. But tons of overhead resistance, so be really, really, really super careful. Real quick before I go, we'll look at. It's going to be really interesting to see what happens when after Powell speaks today. So, real quick, Johnson and Johnson, right? Um, the nice thing about this was, and this was an open trade back over here, right? Open trade, got a really nice move. I mean, it kind of, it completed the pattern. It hit the target and, pulled back and then made a second attempt. And then that next pullback, the trailing stop, basically moved up to, the trigger line. And so the second half of the position just got stopped at a break even. Not a big deal. Um, the one that was like looking so good and off to the races was a CMRE, but it just got taken down with the rest of the market. Interestingly enough, it held like these lows, but the trailing stop was like trailing stop was like what around it was around $12. So it opened a little bit lower and knocked us out at the open on Monday, but it was a really reasonable setup, and it's interesting to see how it held those lows on Monday. It held its previous lows, unlike so many other I mean, so many others didn't hold their lows. And so I want to look at energy real quick. It seems like, oil. Look at this. This is incredible. Let's look at the weekly chart of some of these things. So, you go back and look at XLE. This has been the big winner, the hot sector, but at the same time, it's hard to want to cheer this on because oil, is approaching $90 a barrel. And so I just noticed yesterday they raised the price of gas at here it's like 337 now or something. There's XOP. XOP looks a lot different. It's a lot more diversified. It's a lot more diversified. Like I always like to say, XLE is primarily comprised of ExxonMobil, which has just been on a straight up tear here. They hated ExxonMobil over the past couple of years, and then decided that, here recently, so this is a weekly chart. Anyway, ExxonMobil and Chevron Texaco are, are hitting new highs here. And so that's why XLE is looking so good. But keep your eye on XOP. And quite frankly, I mean, XOP is like, it's got a pretty decent looking pattern here. So this is going to show you what a diversified, like if you had a really diversified portfolio of oil and gas exploration and production, as opposed to, kind of like, how the indexes are all market cap weighted. And so that's basically what XLE is, like a market cap weighted type of thing. So anyway, that's that's where the action is here. Let's see, just for the fun of it, I can pull up. Well, I could have sworn. Oh, it's a $ WTIC. Yeah, these symbols at the free stock chart. So there's a weekly chart of oil, and look at that. I mean, I don't know. I'm sure it's delayed or whatever, but $85 a barrel. Ouch. Got to go all the way. You got to go way back to 2014 for oil to be at these levels, and so that's another thing. I mean, that's kind of another thing that the Fed has to be concerned about, because high oil prices pain at the pumps and all that kind of stuff is just going to help, be a headwind for inflation or a tailwind for inflation. And so if the price of oil keeps going up, then, inflation's going to permeate throughout the broken supply chain. And so it's a mess out there. I don't know what the Fed's gonna do to fix all of it, but anyway, it all boils down to what Powell says today. Oh, my chart's a little skewed here. Yeah, these stock charts, they leave a little bit to be desired, but there you go. So anyway, the SPY, go back and make sure my chart looks okay. Sometimes I'm looking at the other screen and I can see the chart, but it doesn't show perfectly here. So yeah, look out. Like I said, anything can happen here, but the market's already gapped up humongous and tried to push higher, and now it's going red on the day. And so, some backing and filling into yesterday's bar wouldn't be a huge surprise. And then when Powell comes out, hey, it's anybody's guess, what the move is. And the market tends to be really crazy volatile. I mean, not only does the Fed announcement hit, but then he does his press conference, and so he's he's probably not going to say anything new. And so the market's going to have to interpret what they think is going to happen. And so it's going to be fascinating to watch. So anyhow, I will leave it there, and I will see you back here same time next week.